Every year in the United States, millions of people open investment accounts with a simple expectation. They follow market headlines, watch prices move during the day, and hope the right decision will lead to faster financial growth. Some begin with strong confidence, reacting quickly to new information and shifting their positions whenever the market changes direction. Yet when researchers examine what actually happens after several years, a quieter pattern becomes visible. Many individuals who move money frequently, chase short-term trends, or react emotionally to market news experience unstable outcomes. Meanwhile, another group follows a slower and less visible strategy built on patience and structured thinking. Over extended periods, this second group repeatedly ends up in a stronger financial position. The interesting question is why this pattern appears so consistently across different market cycles. Understanding the answer requires stepping away from daily price movements and looking at how productive businesses actually grow inside the American economy. When people first hear the phrase long-term investing, they often imagine a simple idea: buying an asset and holding it for many years. Time certainly plays a role, yet time alone does not explain the results. The deeper logic begins with how real companies operate. Public companies in the United States represent functioning businesses that produce goods, deliver services, and employ millions of workers. Every day, these organizations manufacture products, build technology, transport materials, provide healthcare, and serve customers across the country. Through this continuous activity, companies generate revenue and expand their operations. Over time, successful businesses improve efficiency, introduce new products, expand distribution networks, and strengthen their position within their industries. When investors hold ownership in these companies through shares, they participate indirectly in that business growth. The connection between business productivity and ownership forms the structural foundation of long-term investing. Ownership connects investment outcomes to real economic activity. Once this connection becomes clear, the difference between short-term trading and long-term investing becomes easier to understand. Short-term trading attempts to capture small price movements that occur within days, hours, or sometimes minutes. Long-term investing approaches the market from a different angle. Instead of focusing on immediate price fluctuations, it focuses on the long-term economic progress of businesses themselves. This difference changes the entire decision-making process. Market prices move every day, often in ways that appear dramatic on a screen. News headlines, economic data releases, political developments, and public sentiment constantly influence short-term market behavior. However, something important continues happening behind those price movements. Factories continue producing goods, technology firms continue developing software, healthcare companies continue providing services to patients, retail businesses continue selling products to customers across the country. These operational activities rarely stop simply because market prices move during the day. Long-term investors understand that business productivity evolves over years rather than days. Because of this perspective, they build investment systems focused on ownership duration instead of constant reaction to market signals. This approach changes how investors interpret market volatility. Short-term price changes may still occur, yet those movements become less important when the focus remains on long-term business development. Another structural advantage begins to appear when investors allow business growth to accumulate over extended periods. When companies expand operations, develop new services, or improve their efficiency, these improvements gradually increase the economic value of the business. Investors who maintain ownership during these expansion phases participate in that growth. At first, the results often appear slow. During a single month or even a single year, market movements may look unpredictable. Prices rise and fall without a clear pattern. Yet when longer time horizons are examined, a different picture begins to form. Productive companies gradually scale their operations, strengthen their competitive position, and increase their economic output. Investors who remain present during these long phases capture the results of that expansion. Business growth accumulates gradually, and time allows that growth to become visible. Another reason long-term investing performs differently involves human decision-making. Financial markets place psychological pressure on investors. When prices fall quickly, fear can push individuals to exit positions at weak moments. When prices rise rapidly, excitement can encourage people to enter after large increases have already occurred. These emotional reactions interrupt disciplined strategies. Long-term investors attempt to reduce these behavioral risks by following structured rules. Instead of reacting to every headline, they maintain consistent investment schedules. Instead of searching for quick gains, they evaluate whether the businesses they own continue operating effectively inside the economy. Instead of measuring results week by week, they review performance across longer economic cycles. Structured systems reduce emotional decisions. Another advantage appears in an area many new investors initially overlook: cost efficiency. Every transaction inside financial markets carries small costs. Buying and selling assets repeatedly introduces transaction expenses and market spreads that gradually reduce overall performance. Frequent trading increases these costs over time. A long-term strategy based on extended holding periods naturally limits unnecessary transactions. More capital remains invested in productive assets rather than being consumed by repeated trading activity. Because of this, many experienced investors rely on diversified ownership structures. Rather than concentrating on a single company, they hold collections of businesses across multiple industries within the American economy. Technology firms, healthcare providers, transportation companies, consumer businesses, and manufacturers all represent different segments of economic activity. Diversification spreads exposure across these sectors. When one industry experiences difficulty, others may continue expanding. This structure reduces the influence of any single company while maintaining exposure to broader economic growth. Multiple sectors reduce the influence of any single outcome. The logic becomes even clearer when historical economic behavior is examined. Across extended time horizons, the American economy has repeatedly expanded through innovation, entrepreneurship, and productivity improvements. New technologies emerge, industries evolve, and entirely new forms of economic activity develop. Companies grow alongside these changes. Investors who maintain exposure to broad segments of this evolving economy often participate in the results of that expansion. This perspective does not eliminate short-term volatility. Market declines still occur, economic slowdowns appear periodically, and industries sometimes undergo structural changes. Long-term investors acknowledge these realities rather than attempting to avoid them entirely. Their strategy focuses on endurance. Volatility represents a temporary feature of markets, while productivity represents the deeper driver of long-term value. This understanding gradually shifts how investors frame their decisions. Instead of asking which asset might rise quickly tomorrow, long-term investors begin asking a different question: which productive systems within the American economy are likely to remain relevant, adaptable, and economically valuable over extended periods of time? That single question leads directly to the deeper logic behind long-term investing. When investment decisions align with long-term economic productivity, time begins working as a structural advantage rather than a source of uncertainty. Once the underlying logic becomes clear, the next step involves understanding how disciplined investors apply these ideas in real financial environments. Many strategies appear convincing in theory. The difference between theory and execution often determines whether results remain stable across time or become inconsistent. Long-term investing relies on several structural principles that guide decision-making, reduce behavioral mistakes, and allow strategies to function across multiple economic cycles. The first principle involves recognizing the difference between price and value. Market prices change constantly because they reflect the collective expectations of millions of participants. News coverage, public sentiment, economic forecasts, and short-term trading strategies all influence price movements. These forces create rapid fluctuations that can make it appear as if asset values are changing every minute. In reality, the underlying value of a productive business evolves much more gradually. A company increases its value when it expands operations, improves efficiency, develops technology, or strengthens its position within an industry. These developments unfold slowly because real businesses operate within physical and organizational constraints. Factories must be built, products must be designed, supply chains must expand, customers must adopt new services. Business value develops gradually even when prices fluctuate rapidly. This understanding leads to the second structural principle: diversification. The American economy includes thousands of companies operating across multiple sectors, such as technology, healthcare, manufacturing, transportation, consumer services, and energy. Each sector experiences different economic pressures and growth patterns. Some industries expand rapidly during technological innovation, while others provide stable services that remain essential during economic slowdowns. Diversification spreads ownership across these industries. Multiple sectors reduce the influence of any single outcome. Many long-term investors implement diversification through broad market funds that represent large portions of the American economy. These funds hold shares in many companies simultaneously. Investors therefore participate in overall economic growth without depending on the success of a single business. The third principle involves consistency. Financial markets reward disciplined behavior more reliably than sporadic decision-making. Attempting to predict every short-term price movement requires forecasting countless variables, including economic data releases, political developments, corporate announcements, and shifts in public sentiment. Even professional analysts find this challenge difficult. Because of this uncertainty, long-term investors often rely on consistent investment schedules rather than precise timing decisions. When capital enters the market at regular intervals, the impact of a short-term fluctuation becomes less dominant. When prices are higher, the same investment purchases fewer shares. When prices decline, the same investment purchases more shares. Over extended periods, this process creates an average entry price across changing market conditions. Consistency transforms investing into a repeatable system. The fourth principle involves time horizon alignment. Many individuals evaluate investment performance within very short periods. After several weeks or months, they attempt to modify strategies based on immediate outcomes. This short evaluation window often interrupts long-term growth. Long-term investors approach the market differently. Their evaluation process focuses on whether the underlying economic thesis remains valid rather than whether recent price movement appears dramatic. Investment horizons should match the pace at which businesses actually grow. Another essential element involves information filtering. Modern financial media produces an enormous flow of market commentary every day. Headlines report price swings, economic announcements, corporate developments, and predictions about future market direction. This environment can create the impression that constant reaction is necessary. Experienced investors filter information differently. They distinguish between structural developments and temporary noise. Structural developments include technological progress, demographic shifts, productivity improvements, and long-term economic changes. Temporary noise includes short-term speculation and daily price commentary. Filtering this information allows investors to maintain focus on the forces that actually drive economic growth. Clarity improves when attention remains on structural change. Another important structural element involves reinvestment. When productive companies generate profits, they often allocate capital toward expanding operations, developing new products, improving infrastructure, or acquiring complementary businesses. These reinvestment decisions increase the productive capacity of the company. Over time, each cycle of reinvestment strengthens the organization's competitive position. This process explains why many of the largest companies in the American economy originally began as small enterprises decades earlier. Through sustained reinvestment and innovation, they gradually expanded into organizations serving millions of customers. Investors who maintain ownership during these phases participate in that expansion. Reinvestment allows business growth to compound internally. Behavioral stability represents another factor that strengthens long-term investing. Rapid market changes create emotional pressure. Declines often generate fear, while rapid increases can produce excitement. Both reactions encourage impulsive decisions. Long-term investors attempt to neutralize these pressures by defining clear frameworks before entering the market. Diversification structures, investment schedules, and evaluation criteria are established in advance. When volatility appears, these frameworks guide decision-making. Predefined systems protect strategies from emotional disruption. Another factor supporting long-term investing involves economic resilience. The American economy has experienced numerous cycles, including recessions, technological disruption, and global challenges. Each period introduced uncertainty and structural change, yet the broader economic system continued evolving. Businesses adapted, new industries formed, and productivity improvements reshaped entire sectors. Investors who maintained diversified exposure to this evolving system often captured the results of that long-term expansion. Long-term investing aligns financial participation with the growth capacity of the broader economy rather than attempting to predict individual market movements. When ownership of productive assets, diversification, consistency, disciplined time horizons, information filtering, reinvestment, and behavioral stability operate together, investing becomes a structured system rather than a speculative activity. The results rarely appear dramatic within short time windows, yet across extended periods, the accumulation of business growth, reinvestment, and economic expansion gradually builds financial strength. This is the quiet logic behind long-term investing. It transforms financial participation into a structured partnership with the productive forces that shape the American economy over time.